NVIDIA has been on an incredible run, up 265% over the last 12 months. Over the last 10 years, up an incredible 18,845%. And with the generative AI industry expected to be 1.3 trillion by 2032, which equivalents to essentially 12% of total technology spend. Today's episode, we're going to be looking at 5 stocks that we believe will outperform NVIDIA over the next 10 years that has been on such an incredible run already. We'll look at each company, the historical performance. We'll look at their financial metrics, seeing what exactly we like about this company and the future. And as always, we're going to run through each company in the valuation model. We're going to get to the intrinsic value, find our acceptable buy price, as well as our investor margin of safety. And we'll take a look to see what Wall Street are forecasting for each of these companies over the next 12 months. And at the end of today's episode, we're also going to take a look at 2 alternative ETFs for those that don't like to pick individual stocks and want more security. So stick around for that. So let's jump straight in. The first one we're looking at today is ServiceNow, ticker symbol NOW. Now, over the last 12 months, they have been on an incredible run themselves, up 76%. They do currently trade towards the mid to upper end of the 52-week range, and the market cap sits around 160 billion with a pricey forward P of 59.31. Now, over the last 10 years, they have also been on a decent run, up 1,089%. Now, in terms of their metrics, what we can see on the free cash flow, some very strong growth from 60 cents in 2014 to 13.20 in 2023, and nice long-term growth every single year over the last few years. They have been increasing their free cash flow per share. 2024 expected more of the same, $16.40, so looking very strong. Sales growth, now initially they did have some strong growth, 61% in 2014, 47% in 2015. Yes, it did slow down as we can see. However, the last 2 years have been in the mid-20s, which is still very, very strong for the top line growth, 24% in the more recent 2023 year. When we take a look at total sales, well, 680 million in 2014, just under 9 billion in 2023. They are growing their top line at a very impressive rate. Now, we also want to point out that they have been doing share issuances, so they would have diluted your position if you were a shareholder in 2014, increasing those outstanding shares from 145 million to 206. But bear in mind, you probably wouldn't be too fussed as a shareholder given that incredible run over the last 10 years. In terms of ROIC, now this is interesting. We do see from 2014 to 2018 they were loss-making, hence the negative ROIC. Since then, it has been getting better and better every single year, 8% in 2023. Now, ideally, I do like to see this as 10% or more, just to give me faith that management are able to effectively allocate their capital. Nonetheless, the fact it has been improving over the longer term is a positive sign, in my opinion. Margins then, as we mentioned, they were loss-making up until 2018. Since then, we do see the operating margin increase. We ideally want to see a minimum of 12%, but again, positive to note, like the ROIC, it has been improving over the last few years. Free cash flow margin, quite a little bit of a different story, to be honest. Very strong, in fact, for the large majority of the last 10 years. In fact, the last 4 years in the low 30s is very attractive for investors as well as potential investors. Finally, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, pretty much for the last 10 years and in 2024 expected, we have 0, which indicates it won't even take them 1 day to pay off all of their debt net of cash on hand, so giving us a sign they have a very, very strong balance sheet. So let's jump into the valuation model, and as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we do deep dives. We run into every single one of these models. For today's episode, we're going to jump straight into the intrinsic value calculator, and we have the discounted cash flow valuation making up our intrinsic value for now on today's episode at $879. Now, typically what we do is we get a margin of safety. We start off with 10%, and we use that if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, it's a buy up to $791 at 15%, $747. We keep going till it's near the current trading price. So it isn't quite there yet at 20%. So right now on today's episode, for now, we see a 15 to 20% MOS level based on our estimates and judgments. In terms of Wall Street, well, they have a price target over the next 12 months of $865. They see this as a buy now with upside of 16%. And as always, when we do go through these companies on today's episode, do let us know your thoughts if you have been buying, if you've been adding, or maybe you're adding them to your watch list. The next company that we are analyzing today is DCBO. Now, over the last year, up 36%. We can see, in fact, over the last 5 years when we analyze it, it initially was listed around $50. It isn't too far off that current price now, although we do know essentially its all-time highs sat around $90 in 2021. It is trading at the mid to upper end of the 52-week range with a very small market cap, just under $2 billion, a forward P of 55.23. In terms of the metrics, well, for the beginning of the first 4 years, in fact, we can see negative free cash flow per share, although we do note in 2022 and 2023 they became free cash flow positive, and we do in fact note 2024 that is expected to essentially more than double, showing positive signs that they are starting to have consistent increases and having a positive free cash flow per share. Now, sales growth, similar to the previous company we analysed, it does look like it has started to slow down. Nonetheless, 27% in 2023 is still very, very strong. When we take a look at the numbers numerically, well, they've gone from just under 10 million in sales in 2016 to 181 million in 2023. Similar again to ServiceNow, they have essentially diluted your position over the longer term, increasing those shares outstanding, although they are minimal, from 15 million to 2016 to 34 in 2023. In terms of the ROIC, again, very mixed, as they have had some inconsistent results in terms of the bottom line. We do, however, see in the more recent year in 2023 at 9%, which isn't too far off, remember, that 10% level that we do want to see at a bare minimum. In terms of the margins, well, we can see 2023 the first time over this period where we see an operating profit, 3% margin. We want to see higher, remember, but the positive sign here is that it has been improving over the last 10 years. And a fairly similar story to be told on the free cash flow margin. 9% looking very healthy. Remember, we want to see a minimum of between 5 to 7% for this metric. Net debt to EBITDA, the last 2 years as well as 2024 expected at 0, again showing us that this company, similar to now, does have a very healthy and strong balance sheet. So in terms of the valuation, which is always important to note, let's get to the intrinsic value. And don't forget, you can grab a copy of this model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio or on your watch list by clicking on the pinned comment below. So it does have a 10% margin of safety up to $59, 15% up to $56, 20% pretty much not far off the current trading price. So we see a 20% MOS level for this company in today's episode. What about Wall Street? Well, they have a price target pretty much near enough our intrinsic value. They believe it will hit that over the next 12 months. They see some very strong upside of 25%, calling this a very strong buy in their opinion. One thing I would say though, as we do go along for these companies, bear in mind with Wall Street, do take their forecast with a pinch of salt, as essentially when the prices do rise, they revise their targets upwards. Likewise, when it comes down, they do change it downwards as well. So while you can include it within your own investment thesis, always do your own due diligence and just use this as one part of many when you are researching companies. The next company that we are taking a look at is AMAT Applied Materials. Now, it is up 65% over the last year, and when we take a look at the last 10 years, up 885%. Currently trading in the mid to upper end of the 52-week range with a yield. So this is a company that does officially pay a dividend, 0.8%. Forward P looking fairly attractive at 24.43 and a market cap of 167 billion. Dividend safety score, so the first one we have a score given they do pay a dividend of 86, looking very safe. Market cap 167 billion, they are a mega cap company. Last recession, so we have some key metrics. They maintained the dividend during the 07-09 crash. They didn't cut it, they also didn't increase it. They had below recession sales, negative 38% versus the S&P's negative 12, and they had a near recession return, negative 57 to the S&P's negative 55. In terms of dividend growth, well, very fast. They had a dividend increase just this month, 25%, absolutely incredible. Last 5 years, 12%, very strong double digits, and the same to be said for the last 10 years. And when we take a look, they have been increasing those dividends for the last 6 years, and paying a dividend, in fact, for the last 18 without a reduction. Now, dividend yield theory, as always, states the company is undervalued when the current yield sits above the 5-year average. Here we have a sign of reasonable valuation / slight overvaluation given the yield is below. We can, however, see the forward P is much higher at 24.2 versus that 5-year rolling average of 16.5, but we do note it is lower than the information technology sector PE. Now, we can cover quickly the free cash flow payout. Typically, we want to see below 60%. Industry specific, you can go lower to 50% for the semiconductor industry. Earnings data, for me, susceptible to manipulation by management through accounting, so I draw your attention to the free cash flow. It's been pretty much below 50% for the majority of the last 10 years, 13% in 2023. Even though it is expected to increase to 20% in 2024, I would still expect double-digit increases from this very consistent dividend growth company. Free cash flow per share also been increasing over the longer term. We do see some inconsistencies, but nonetheless, 128 in 2014, 904 in 2023. But do note they are expecting a drop to this in 2024 to around $8.12. Sales growth, nice to note they have some strong increases year on year. Whilst we typically look for steady, moderate 3 to 7% growth, we can see over the longer term it has beaten that. We do see that drop in 2019. Other than that, looking very strong and very healthy. And overall, they have in fact tripled their top line from $9 billion in 2014 to $26.5 in 2023. Nice to note the first one we have taken a look at today that returns that excess cash to your pockets through some very nice shareholder buybacks. $1.23 billion in 2014, $842 from the latest report. So they are increasing your stake in this pie. ROIC, very strong as well. Very, very nice to note it is increasing as well. 16% was very positive in 2014. The fact they've been increasing this over the longer term and 34% in the more recent year is very, very positive for shareholders and potential investors. Margins, very strong operating margin. The operational efficiency is shown with an increase from 17% to 29% in 2023. And the free cash flow margin, very strong consistently every single year. 29% in 2023, looking incredible. Net debt to EBITDA, not much to say. Pretty much the same as the previous company. 0 in 2023, 0 expected in 2024. Very healthy balance sheet, very strong. No issues as well with that dividend safety. So let's get to the valuation of AMAT, and today's episode, the intrinsic value is arriving at $235. So we can see margin of safety at 10%, a buy up to 212, 15% 199, so not far off our current price. So we would say a 15% MOS level based on our estimates and judgments. Wall Street, well, they're forecasting $240. They have upside of 21%. They believe the share price will rise higher than our intrinsic value. So they see this as a very strong buy now. As always, though, don't forget to let us know your thoughts in the comments below. The next stock that we are taking a look at is Marvell Technology, up 78% over the last 12 months. Over the last 10 years, up 313%. And they still haven't got to their all-time highs that we saw in December of just under $90. They're in the midpoint of the 52-week range, a forward P just over 46. They also offer a yield 0.36% and market cap of $57 billion. Now, they also pay a dividend, so we have a score 42 borderline safe. We can touch upon that throughout this episode. $57 billion, they are a large cap company. Recessionary metrics, well, they didn't pay a dividend during the last recession. They had negative 25% recession sales, so below the average growth, and they had pretty much a near S&P return. They also haven't increased their dividend for quite some time, as we can see. In fact, from 2014, it has been kept pretty flat all along, but they have been paying a dividend for the last 11 years without a reduction. Dividend yield theory, then, we do have a sign of overvaluation, both on the yield as well as that forward PE, but always important to understand we're not looking at these models in isolation. They also have a P much higher than the information sector P of 27. So we can have a quick look at the free cash flow payout, pretty much below 50% for the majority of the last 10 years, 20% in 2024, 16% expected next year. So it is surprising why they aren't increasing that dividend. Nonetheless, there is a lot of room, so no worries for them in terms of just paying what they are currently doing. Free cash flow, it has been very inconsistent, and over the last 10 years, it hasn't really moved if you look at 2015 to 2024. Positive, however, to note that 2025, they are expecting an increase, as we can see, to $1.49. Sales growth, a little bit cyclical. I guess you could argue that this industry as in itself is cyclical, and therefore we do see positive years followed by negative. Negative 70% in 2024, not great, although do look at the last 3 years before we did see some strong double-digit growth to their top line, and we do note it has increased from 3.6 billion to 5.51. Now, unfortunately, they would have also diluted your position as a shareholder if this was one you have been holding over the last 10 years. In terms of the ROIC, pretty inconsistent, especially over the more recent period, negative 2%, so we can understand from that they haven't made a profit in 2024. Although we do see they have had some good years around 2015 to 2018, but this hasn't showed over the more recent period. Now, free cash flow margin and operating margin. Well, the operating side, in fact, we can see 2020 to 2022 and 2024, they made an operating loss. 7% was their operating profit in 2023. Pretty inconsistent over the last few years, so it will be interesting to see how our valuation accounts for this. Free cash flow margin, for the large part, very, very strong and very, very consistent, which doesn't seem to be the case for the majority of these metrics. Net debt to EBITDA, so we can understand that borderline safety score. Whilst their free cash flow payout was pretty low, we want to see a maximum of 1.5 for semiconductors. We see it higher in 2024 and expect it even higher in 2025. In reality, the yield is very low, their payout is very low, so there are no real worries, in my opinion, to the dividend, but something just to keep an eye on and maybe factor this in when we do look at that margin of safety level. So let's get to our intrinsic value, and for today's episode it arrives at just under $90. We can see the current price is very low, that in fact $67, so we should expect a fairly decent margin of safety, and as always we keep going till it's near the current trading price, and we can see it is a 25% MOS level on our estimates and judgments, but remember this will depend on every single investor, their own risk profile, and whether or not this is an industry that they do believe should have an added level of margin of safety. In terms of Wall Street, well, their forecast is strong upside, 34%, similar to our intrinsic value. They have a price target of $90. They do see this as a very strong buy. In fact, the strongest buy of the stocks we have reviewed so far. But again, remember what I did previously say on Wall Street's forecasts. The next stock that we are taking a look at is Baidu. Now, BIDU currently trading at $104. Now, over the last year, this is down 24%. We can, in fact, see over the last 10 years down 34%, their all-time highs, sitting around $340. Currently trading pretty much near the 52-week low. No dividend, their forward PE below 10 and a market cap of $36.6 billion. Now, they don't pay dividends, so straight into the free cash flow per share, going from $28.90 in 2013 to $51.10 in 2022. So it has increased over the long term. Again, do note some inconsistencies, but it looks like it has rebounded every single drop it has faced. 2023 expected to go higher, 2024 even higher. So the growth prospects do look positive for BIDU. In terms of sales growth, well, whilst it was pretty decent from 2013 to 2018, we do note since then very inconsistent and irregular. 2022 negative 1%, so revenue dropped in fact. 2023 they're expecting around a 6% growth, which isn't too bad, but it does look like their top line is reducing, so something just to bear in mind and consider management's forward guidance. Nonetheless, the top line has increased from 32 billion in 2013 to 124, and the shares outstanding has really moved very marginally. It has increased by around 3 million, which we would consider to be trivial. ROIC, now remember we want to see 10% or more, and it looks like it has been decreasing. The last 5 to 6 years haven't been the best, so something just to consider. And always, it doesn't mean these companies aren't investable, but it may impact the level of margin of safety that you do give to each of these companies. Operating margin, we do see it has decreased over the long term, so we would call this operational inefficiency, so not great, but bear in mind we do want to ideally see around 16%, so it isn't too far off it for the large part, although we do see 2019 wasn't the greatest year. 2023, as we can see, 16%, pretty much in line with what we expect. A very similar story with the free cash flow margin. It has been decreasing, but again, on the free cash flow, we want to see around 5 to 7%. So again, nonetheless, not looking too bad. 2023 at 19% is also fairly solid. Net debt to EBITDA, again, pretty much zero every single year and expected over the next 2 years. So no worries to essentially their balance sheet strength. So what about the actual valuation of this company? Let's get to it. And today it comes to $164. Now, when we take a look at the current price, that is much lower, so this would give us a very large margin of safety, so we can go in denominations of 10%, And we can see at 40%, it isn't quite there yet. At 35%, pretty much near enough. So it has a large 35% margin of safety. But again, different people will have different margins of safety. Just because we say a 10% margin of safety means it needs to meet those 3 criteria. You may have attached 20% to those criteria. It all comes down to the individual investor. We can see Wall Street giving it the best upside out of the stocks we have considered today, 59%, a price target of $165. So they do see this as an incredible opportunity, an incredible buy right now. As we mentioned at the beginning of the episode as well, there are alternatively 2 ETFs that you can consider if you do want to be exposed to the technological market. We have VGT, which is a very popular choice, a very attractive expense ratio as well at 0.1% as well. In terms of the actual performance and in terms of the composition, well, we can take a look in terms of the holdings. We have Microsoft as their top holding, 18.21%. Apple, NVIDIA, Broadcom, Advanced Micro Devices, Salesforce. So these are companies that do give you exposure to the AI region that we talked about. May not be the exact same stocks, but they do give you some strong coverage, and this is one of the strongest ETFs out there. There is another alternative. You have XLK. Now, this is the Technology Sector Selector SPDR Fund. Now, this has a slightly lower expense ratio of 0.09%. In fact, this was actually only recently reduced from 0.1% that we saw for VGT. In terms of their holdings, very similar. We have Microsoft again as their top holding, quite significantly weighted. We have Apple, NVIDIA, Broadcom, AMD, Salesforce, pretty much very similar like for like. These are some good ones to consider if you don't want to be picking individual stocks, as it is a lot harder to gain those returns if you are just picking 1 or 2 stocks, whereas you get that exposure from these ETFs. Finally, just to let you know as well, we have released our latest free weekly article, so if you do want to gain access to all of our newsletters that we send out every single week completely free, do click on that pinned comment below to sign up and gain access straight away. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.